All right, everyone. I saw this stock today on Twitter, so it's probably not anything amazing, but thought it was interesting. I've seen it before in the past, so I figured we would kind of look at it today, see what we find. So I always like to do three things. I like to look at the valuation, the latest earnings, and then other items to consider, whether that's like a short interest or a big upcoming catalyst. If insiders are selling, any news, total outstanding shares, those sorts of things. So let's just start to see what this is. It's a commerce enabling technology, independent provider of software and payment processing solutions in the United States based on total volume of payments processed. Okay. The earnings is very interesting. They got all kinds of PowerPoint type stuff. You don't see that in every earnings. But I went straight to the financials, and I'm going to start with the income statement. So you can see right here, gross revenue is improving. That's pretty solid growth right there. And then the cost of sales percentage wise is growing along with it. G&A almost doubled. So it's not great. You don't love to see that. I'm going to ignore depreciation. And then their income from operations year over year did improve. So still growth, and improved, by about 30%, 30%. So that's pretty good. I want to see if there's anything else in here that is, okay. So this interest expense right here, this is telling me they have some sort of debt. So, and that interest expense alone took away half of their income from operations. So it's always tough to see that. The interest expense also almost doubled year over year. So it looks like they took on a lot of debt recently, which could be good or bad. We'll look at the balance sheet after this. So, all right. And then they have some preferred stock payouts. And then you're looking at a net income of, this is probably 25 million. Which went down. Why did it go down so much? What's the deal here? Oh, last year in 2024, they had some sort of a security gain that helped them out. And then a tax benefit they must have been using. So that's why so I know this is showing a big decrease year over year, but that's from one-off things, so I wouldn't be too worried about that. But this is interesting, this interest expense almost doubling. Let's look at the balance sheet now. Pretty solid cash position. I'm gonna imagine this is some sort of like collateral or something they need for their business. Big AR. They have a lot of goodwill. So that makes me think that they've done some sort of like acquisition or something like that recently. And then a lot of intangible assets. Yeah, holy cow, they have a lot. What are the goodwill and intangible assets sitting on for stocks and financials? Just curious on this. Yep, we know that. Oh, it's thinking I'm asking for 4 stocks. That's funny. And I mean SHIFT4 payments stock. AI, I thought I was asking for 4 random ones. Okay, there you go. You got it. 61% of total assets are intangibles and goodwill. So an acquisition. Blue, they've done a bunch of acquisitions. Global Blue, Smart Pay, Prior POS. So this growth is not organic. Well, Yeah, it's not organic. So that gives you some insight on this revenue growth, is that maybe this just comes from their acquisitions. Um, so yeah, this is what I'm trying to see, is that, are there all these deals that they're making, is it working out for them? So very aggressive merger. So that's something to look out for on their assets, because they've done a lot of acquisitions. And I would bet that's why. Remember when we saw the interest expense increase? I would bet they went into debt to do those acquisitions. Current portion of debt is not that bad. Um, holy cow, look at that long-term debt. Yeah, very leveraged company. And they got a lot of, preferred stock, which, that's going to take away from their income every 3 months. So lots of debt, and, well, this convertible preferred stock, but still, like, this is just something to be aware of. Like, doesn't mean that the company's trash. Like, it's making money, you know, it's making money. It's been growing. It has, a solid cash position. It's not like it has to, I mean, this interest expense will keep eating away at them, but it's not like they have to pay it off, they got their cash runway. So, but it's just something to be aware of. So it's kind of interesting. I do want to kind of look at the mergers too. The acquisitions, that for has made, how can we know if it's been what they were looking for or not? That's the worst prompt you could ever see. Okay. The return on investment is going to be kind of hard to read. The revenue did grow, but yeah, you're looking at, is it buying growth rather than creating it? This is one thing that I've noticed with SoundHound too. Um, EBITDA is growing, but cash flow isn't a warning sign. Let's look at the cash flow on this real quick. If I can find it. Statement of cash flows. Net cash providing by operating activities. I mean, that's not what I'm seeing. It looks like they're getting more. So you look at this, you got net income, depreciation was pretty heavy for these last 3 months, probably from the goodwill stuff. They are doing a lot of compensation expense, so look out for that. It's going to be a little dilution. We'll check that out later. Subsidiaries. So they did get some cash from here. That was a gain, yeah. Yeah, so I'd say the most interesting thing here is this: they had a sale of their subsidiaries that gave them some more cash here, but it seems fine to me. Investing activities. So here's all these acquisitions, net of the cash acquired. And then I wanted to see here real quick, financing activities. Look at this. Interesting. They've done some repurchases of their stock. Repayment of debt. And then proceeds from long-term debt. This is interesting. They're kind of doing a whole bunch of things. They got some debt, but then they paid the debt probably for servicing their debt or not. But then they bought back shares. That's interesting. And did this company do their share buybacks? Okay, 100 million buyback. Authorized a 500 million buyback. Authorized a 1 billion buyback in November 2025. Holy cow. If they did this, that's buying back 70 to 20% of the shares. I mean, they're making money, but to do a 1 billion buyback, they made what, 25 million in this latest earnings? Yeah, 25 million. So this must be over time. But yeah, that's interesting that they're doing that. They're making money. They're kind of okay with their debt, so that's interesting. All right, let's look at the valuation here real quick. Okay, so you're looking at 3.7 billion to make 25 million every quarter, and if they were to make that every year, then you're looking at 100 million revenue. So that puts their P ratio around 42, which makes sense. Shares outstanding. This isn't bad. Look at this, 81 million. That's pretty low, actually. And if they keep doing buybacks, it's just going to keep going lower. This is low. In my opinion, anything under 100 million is good. Anything under 50 million is great. But I like the lower outstanding because then it requires less volume to move the stock. So that's not bad. Looks like we're on a downtrend here. Definite downtrend. This 50, right at this 50-day moving average. Yeah, earnings is great. Let's look at this financial screenshot. I mean, this is pretty solid revenue growth for the past 5 years. This makes me believe that, I mean, sure, they're doing acquisitions and they're growing that way, but pretty consistent to me. Cost of goods sold is they've actually improved their gross margin a little bit. Because look, in 2020, you went from less than 200 million gross margin to now your gross margin is almost well, not almost, it's a little less than half, maybe about a third. So maybe that's not terrible. Their operating income has been slowly growing, which is great. And then their net profit has been took a big hit year over year. I'm sure that's from some sort of thing. We don't need to go look at that, but diluted average share. The share count has doubled over the past 5 years. So yeah, diluted shares. We went from 45 million to 88 million, but so that's something to watch. And that's probably because we saw this earlier with the share-based compensation, so that probably is playing a part. Yep, here's the gross margin. Like we were saying, it's gotten a little better. And the operating income's also been improving. So, this is interesting. I don't know what I think about this guy. This one's, are insiders buying the stock? Oh, dang. Look at this. Founder buying, 2 million worth. Over the last 24 months, insiders bought 42 million worth of stock. Yo. Okay. Oh, but now they're gonna take me down here. Other insiders are mostly selling. Um, Insiders own 25% of the company. Isaacman's heavily exposed. That's funny. Yes, it's mainly the founder though. What a Chad. Yeah, strong. This is the founder. That's conviction. Founder-led company. Look at that. Um, yeah, what a freaking Chad. So that's kind of interesting. I like that. Founder's all about it. Um, huh. This one's so interesting, this stock, because I don't know. I can see like what's great is that they are making money. That's solid. They have been growing. The PE ratio maybe could be considered a little high. I guess we could look at that. Is the based on P? I'd have to see what the competitors are. P ratio is the stock overvalued. How is it compared to peers? This is important. This forward P ratio being only 8 to 10. Yeah, this forward P ratio implies earnings are expected to jump significantly. This is based on the projections. Here's the P range. Forward is cheaper than all, and then trailing is in line or slightly higher. Hey, so look at that. If anything, yeah, it's maybe a little undervalued. Earnings quality concerns. So this is true. These acquisitions that we saw earlier, lots of goodwill. So that kind of maybe messes with the number a little bit. Because if you're doing depreciation a bunch, you take that. So maybe it should be focused on the free cash flow. Maybe that's what we should look at. Let's look at the free cash flow instead. How does it compare now? Yeah, so this is what it wants us to do. Free cash flow. It's still been going up, and we saw that in the statement of cash flows. Burning cash to generating 500 million a year. Operating cash flow. Yeah, this is pretty solid. Payment giants, yeah, cool. Yeah, this debt load though is still there. Man, yeah, let's look at that debt. What is their debt to equity ratio? I know that when we looked, they had a lot of debt. Okay, 3 times debt to equity. So $3 of debt for every dollar of equity. So that's a lot. That is pretty high leverage. But yeah, it's starting to come down. You know, this is an interesting stock, guys. What an interesting stock. I don't know what I think about it because I think you're seeing massive free cash flow growth. You're seeing it's making money. You're seeing it's doing mergers and acquisitions and growing. The valuation, if you're doing forward-looking P ratio, is maybe even undervalued. It has low shares outstanding. There's a lot of debt. It's a lot of debt. And then there's, pretty heavy goodwill on the balance sheet. But this guy is interesting. I really enjoyed looking at this one. So if you know more about this stock or have other things that I didn't think about, let me know. Because again, this is kind of I treat this as like a discovery for me and maybe anyone else who hasn't seen anything about it, and hopefully it could be helpful to them. So yeah, let me know what I missed or what you think about it, and I'll see you guys in the next one.